Hi, I'm Chad Justice, and I'm the founder and managing principal of Collaborative Wealth. We're a comprehensive financial planning firm that specializes in preserving wealth through advanced estate planning and tactical portfolio management. It's natural to think that if global economic growth is going to be weak, then stocks are going to be avoided. However, despite our outlook for sluggish U.S. economic growth of about 2% and a mild recession for Europe, we expect high single to low double-digit returns for the S&P 500. We expect these gains to be driven by earnings growth in the high single digits and a modest rise in the P/E ratio from recession-like levels as sentiment begins to rebound. Domestically, we expect stocks to decouple from U.S. GDP growth as corporate profits are driven more by business spending and manufacturing than the more consumer spending driven GDP. Overseas, while Europe is likely to experience a mild recession in 2012 and Japan struggles to rebound from recession, solid growth is expected in emerging economies, benefiting a substantial 25% of U.S. corporate revenues. The net result is slow growth rather than a contraction that would not favor stock market exposure. Slow growth is not bad for the stock market. In fact, over the past 40 years, the S&P 500 median return is 10% when real GDP grows less than 3%. More important for stocks than domestic GDP growth is business spending, which we forecast to grow at several times the pace of consumer spending. In the third quarter of 2011, capital spending by businesses on equipment and software rose at a strong annualized rate of over 17%. As a business cycle matures, growth often becomes variable. With the official end of the last recession in mid-2009, mid-2012 will mark 3 years of the expansion. GDP and corporate profits have rebounded to an all-time high. As we progress from the early stage of rebound to the middle stage of slower and more variable growth, stocks still tend to provide solid returns, although lower than in the earlier years of the rebound. Looking back at mid-cycle years during the last two business cycles, 95 and 2006, they experienced slower than average economic growth, but produced double-digit gains for the stock market. During those years, business spending increased at high single-digit to low double-digit rates, while consumer spending grew at a modest pace between 2 to 3%, similar to what we expect in 2012. The stage of the business cycle can also be a guide as to where to invest within the equity markets. Periods in the middle of the business cycles tend to favor the most economically sensitive or cyclical sectors, such as industrials. Although there may be opportunities to move into defensive sectors in 2012, tactically, over the course of what we expect will be another volatile year. We expect better returns from the more economically sensitive sectors. Stocks continue to price in a very pessimistic growth and profit outlook. While we believe the Wall Street analyst consensus for earnings growth is a bit too high for next year, we agree with the analysts that companies in more cyclical sectors are likely to grow earnings at a more rapid pace than those in defensive sectors in 2012. In 2012, stock market investors may benefit from focusing on areas that are likely to be rewarded by the strongest areas of growth driven by business spending and emerging market demand: commodity stocks, small and mid caps, and emerging markets. The stocks of commodity producers are well positioned heading into 2012 due to their exposure to fast-growing demand from emerging market economies, as well as their cyclicality. Very stimulative U.S. monetary policy, a weak dollar, and emerging supply constraints in several key commodities, including copper, should also be supportive. We believe these stocks will perform well if China's growth stabilizes, a soft landing, after deliberately slowing in the past couple of years. Commodity stocks are trading at below average historical relative valuations despite the favorable mid-stage of the U.S. business cycle that has historically favored these stocks, along with strong growth prospects in emerging market countries. We expect small and mid-cap U.S. stocks can provide attractive returns for investors in 2012. Smaller capitalization companies tend to perform better after the economy emerges from mid-cycle soft spots and credit markets improve. We expect small and mid caps to benefit from increased merger and acquisition activity in 2012 due to the significant amount of cash, north of $1 trillion, on non-financial company balance sheets. Potential headwinds include less exposure to fast-growing emerging market economies. We believe mid-growth is particularly well positioned due to the concentration in cyclical sectors. We see attractive return potential in 2012 for emerging markets as economic growth far exceeds that of the developed world. In addition, monetary policy is becoming more positive with central banks beginning to reverse course and cut interest rates. We see China averting a hard landing, growing in the 8 to 9% range rather than the 5 to 6% as some fear. Emerging market economies in aggregate should only slow marginally in 2012 and still grow at about 6% pace. A weaker US dollar may add to the attractiveness emerging market returns in 2012. In general, we caution investors not to ignore valuations to chase yield. We don't expect an emphasis on yield to be as rewarding in 2012 as it was in 2011, since interest rates will likely rise and valuations for highest yielding sectors leave less room for valuations to rise than the lower yielding, more cyclical sectors. Through November of 2011, stocks in the S&P 500 yielding more than 3% have returned 4%, while those yielding less than 1% have matched the S&P 500 with essentially break-even returns. If you have found value in my commentary, then please press this subscribe button above me to subscribe to my YouTube channel. This way you can remain updated on valuable financial planning concepts and my weekly market updates. Lastly, please connect with us on Facebook, Twitter, and LinkedIn, and visit my website at www.chadjustice.com. Thank you, and we'll see you next time.